Howdy, Team 42. It's your skipper here, Darius Dale, to present a macro minute for Tuesday, March 4th, 2025. As always, we'll start with the executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions and to see if you need to make any changes in your portfolio to remain on the right side of market risk, you need to be a client of 42 Macro. So today's key macro question is, how much do President Trump, Elon Musk, and Scott Bessent want to kitchen sink the economy and asset markets? Our answers are, in a move that underscores his aggressive stance on trade policy, President Trump has followed through on his threats to impose sweeping tariffs on Canada and Mexico while doubling existing duties on China. The newly enacted 25% tariffs on most Canadian and Mexican imports, which feature a reduced 10% levy on Canadian crude oil, along with an increase of 20% on Chinese imports, represent a seismic shift in global trade dynamics. This latest tariff escalation brings U.S. import levies to their highest average level since 1943, according to the Budget Lab at Yale. Per their research, the potential consequences are substantial, with American households bracing for up to $2,000 in additional costs due to these tariff increases. With these tariffs impacting over $1.3 trillion of annual imports, the message to markets is clear. President Trump may be opting to kitchen sink the economy and asset markets, which is a view we authored last fall that has quickly gained popularity among investors. As the world grapples with the consequences of this strategy, investors and governments must navigate an increasingly complex and volatile landscape where policy decisions in Washington, Brussels, and Beijing carry profound and immediate implications for global stability. There's likely more pain to come in the months ahead if the Fed does not proactively expand its balance sheet to reduce the crowding out of global financial markets by the U.S. Treasury. That would also reduce the risk of a global debt refinancing air pocket. The debt refinancing clock is ticking, Mr. Powell. Tick, tick, tick. Transition to our 42 macro dashboard. As always, we'll wrap up with a question from our community. This one's regarding global debt refinancing air pocket, print money. Says not that it's the best solution, but if we've got this pocket of debt rolling and investors not having liquidity to take up that renewed debt, what's stopping, what's stopping the Fed essentially from printing excess money to soak up that supply? So again, this is what we've been arguing for, is the Fed needs to revise its inflation target higher so that it can go back to expanding its balance sheet and reducing pressure off of international investors, the private non-bank sector, from capitalizing the U.S. government so that we, the private non-bank sector, can go back to capitalizing companies, consumers. Right. That's been the issue in my opinion, that's been the primary issue of why we had such a K-shaped economy. We're not allowing capital to flow efficiently through the economy. And also because the U.S. government's the balance sheet's been so big and the deficit's been so large, we've had this, sort of awkwardly resilient economy that is operating with a level of above trend, nominally in real economic growth for such a long time that's caused interest rates to be way too high for, consumers and businesses that finance, on the short end of the curve. The big companies and the rich consumers finance on the long end of the curve. But so that's been really supportive for their, for their economic activity. But again, it's been perpetuating this K-shaped economy. So in our opinion, we think the Fed has a very important and, sort of historically, important choice to make this year in order to prevent a global debt refinancing air pocket. And that choice would be to, again, revise its inflation target higher, which would give it more policy flexibility to, again, reduce the pressure upon global investors in terms of capitalizing the U.S. Treasury market. If they do not do that proactively, then we know for a fact they're going to take out their mop and mop up blood from the streets after a crash. And again, I said this already in January at the beginning of the year. I said in December, I think I said in November as well, asset markets will crash in 2025 if we have a global debt refinancing air pocket. And that global debt refinancing air pocket will be perpetuated by a decline in liquidity that tariffs and a contraction in global growth are contributing to. Tariffs reduce liquidity in two ways. One, they siphon would-be corporate profits, would-be household savings, and would-be FX reserves to the U.S. Treasury instead of global capital markets. Number two, you typically see a decline in currencies from the countries that the tariffs get levied upon, so that drains global liquidity as well from that perspective. And so that's negative. Obviously, the tariffs, potentially they will cause contraction in global trade, which also slows the growth rate or contracts the growth rate of global FX reserves, fiat FX reserves, which also get recycled into dollar-denominated assets. So, this is a complicated situation, and that is getting worse. And it's consistent with our views, the long-held views of, we authored the theme that, hey, they might come in and try to kitchen sink this thing. in order to create a low comparative base for their, for the rest of the President Trump economic agenda to be compared against. They have a window of opportunity to blame President Biden to institute a lot of the pain that we're currently seeing and deliberating in asset markets. And so they may continue to down this road. And we need to be aware of that as investors. So we're wrapping up there. Darius Dale here presenting our macro minute for Tuesday, March 4th, 2025. Best of luck out there. Catch you back here tomorrow. Cheers.